Hello traders, this is Liam McMahon. Thank you for watching another part of our coaching series. This one is on risk management and trading the setup and a bunch of stuff that will help you be a more successful trader. So take a moment to pause the recording and read the risk disclaimer, and then we'll get started. Okay, so like I said, this is a video about risk management. It's about trading the setup. It's about risk-reward ratios, preserving that ratio, their importance to trading, and then I give you sort of the outline of a risk management set of rules that you can use. We talk about how to use them, the importance of using them, etc. All right, so let's talk about the importance of managing risk. The two most important things in trading are patience and risk management. These two, of course, aren't mutually exclusive. It's impossible to have good risk management without good patience. Patience means waiting for setups that have good risk to reward ratios, something we'll talk about very shortly. Patience is about not chasing. It's about waiting for the right price. Risk management is about ensuring that your capital is used in the best way possible. Without risk management, even a great trader, someone who has a very brilliant insight into the market, someone who knows everything there is to know about technical analysis, fundamental analysis, without risk management, they're hopeless. They'll be a great analyst, but they'll be a terrible trader. And it's impossible to succeed without some system for managing your risk. Alright, so let's talk about risk-reward ratio. The risk-to-reward ratio, which I'll abbreviate as RRR in the slides, needs to be a trader's best friend. It's the ratio between the amount of equity or capital that you're risking per trade and the amount of equity that you'll be gained if you're right and have a successful trade. So to figure out your risk-reward ratio, you need to look at your stop and your target. A 10 pip stop and a 20 pip target, for example, gives you a risk-reward ratio of 2 to 1. While a 15 pip stop and a 60 pip target yields a ratio of 4 to 1. So your target is 4 times as big as your stop. So a good ratio of 4 to 1. In general, you should be looking for at least 2 to 1. And you should always avoid setups with a negative risk-reward ratio, which means you have more risk. You're risking more than you're going to succeed with. You're going to win if your trade is correct. So in the same vein, we need to talk about probabilities and why they matter. It's very easy to give yourself a great risk-reward ratio by setting a 10 pip stop and having a 10,000 pip target, a nice 1,000 to 1 risk-reward ratio. This type of trading is still going to get you negative results because the odds of a pair moving like that is basically zero. Pairs don't move 10,000 pips in one direction very often. Not to mention the fact that if they did, it would take years. So your equity's tied up for years and years, and it's hard to generate a consistent profit if your equity is tied up in trades for most of a decade. So what traders have to do is look for setups with well-defined stops and well-defined targets. You can define these stops and targets however you want, whatever your style of trading is. Elliott waves, Ichimoku, technical formations, trend lines, fib levels, moving averages, etc. Any possible combination of technical analysis will give you stops and targets. Whatever suits you best as a trader, whatever strategy you're used to using, you can use to find well-defined stops and well-defined targets. Like I said, the system or strategy almost doesn't matter. It's whatever works for you. The key is ensuring a healthy risk-reward ratio by using well-defined and therefore significant areas for stops and targets. If you're putting your stop somewhere, it should be at a significant level, where when price hits that level and you were stopped out, that means you were wrong on your analysis. Your target, same thing. When you place a target, it should be at a technically significant area, a measured move, a key moving average, places where you're expecting a reversal or more consolidation. Alright, so let's give some outlines for risk management rules. Never have more than a 50 pip stop. Really, even 50 is too big. My average stop is usually 30. I will occasionally drift into the 50 pip range, very rarely. Never more than 50. Never have a wider stop than is necessary for the setup. If there is a particular level that invalidates the setup and it is 20 pips away, your stop should be 20 pips. Don't give away an extra 30 pips just to give your trade room. Find the setup. If you have a well-defined setup, put your stop where your setup is invalidated. Never have worse than a 2-to-1 risk-reward ratio. 3-to-1 is preferred, but at the very least, make sure your target, your significant target, is twice as far away as your significant stop. Move stops to break even and take a quarter profits after the trade has moved in your direction the distance of your stop. So, for example, if you have a 20 pip stop, move your stop to break even and take quarter profits when you are 20 pips in the money. This means a quarter of your trade has a 1-to-1 ratio, but it ensures that you get something out of the trade, and the remaining 3/4 are allowed to run, ensuring that your risk to reward ratio is at least 2-to-1 or 3-to-1 preferred. Okay, so let the trade run to targets, preserving your risk reward ratio. Aggressive traders may wish to trail their stop in increments of their stop. So trail your stop 20 pips for every 20 pip move if you had a 20 pip stop, which maintains a positive risk to reward ratio and is more aggressive in profit taking. This set of rules will ensure that your risk reward ratio is never negative and helps you protect your profits while still allowing your trade setup to work. Whether or not you trail your stops is up to you. Ideally, maybe you move your stop 20 pips for every 40 pip move, increasing your, giving yourself a slightly better risk to reward ratio while still making sure that, you're protecting profits. You do want to protect your profits. Not to the extent, though, that some traders do, which we'll talk about in a minute. A couple other assorted rules. Never move your stops, by which I mean never increase your risk. Place your stops at a point where the trade setup will be invalidated, and if you do this, there's no reason to move your stops. Rookie traders, new traders, even experienced traders often move their stops because they hate being wrong. No one likes getting stopped out. You see price action approaching your stop, so you panic and you move it. Doing this destroys your risk to reward ratio, and it means you're probably going to be taking heavy losses. You might be over leveraging on your account. If you're adding to a position, whether a winning position or a losing position, make sure you had planned for that possibility when you plan the trade, and the possibility is included in your risk-reward ratio. I do not subscribe to the belief that you should never add to a losing trade. I think if you plan a trade correctly and you enter at market and have a plan to enter again lower if you get a better price, even if it means you're adding to a losing trade, as long as it fits with your trade setup and your risk-reward ratio, I think that's perfectly acceptable. However, whenever you add, make sure it's a possibility that you had planned for. Alright, so now we're going to talk about the commonly spouted bit of nonsense. You will never go broke taking profits. That is absolutely false. Taking early profits is probably the second most common reason behind moving your stops new traders fail. Alright, let's take a look at why this is. If a trader risks 40 pips on every trade, all losing trades will result in minus 40. Very few people are willing to cut losses early. In order to have a positive risk-reward ratio, target should be at least 80 pips, meaning that hitting 50% of your trades will result in a tidy profit. If the trader panics and takes profits after 20 pips every time, hitting 50% of your trades will result in a loss. Taking early profits requires traders to be correct far more often than is likely than the challenging world of Forex. It's very hard to be right more than 50 to 55% of the time in this business. That's just the way it is. Markets are unpredictable, they move in sudden and unpredictable ways, and you're going to get stopped out. Preserving a risk-to-reward ratio and not taking your profits early is the only way to be successful. Protecting profits by trailing your stop is one thing, especially if you make sure to preserve the risk-to-reward ratio. Panicking and closing early is a great way to ensure you have a short run as a Forex trader. So, in conclusion, when planning your trades, remember to ensure a positive risk-to-reward ratio, including any add-ons that you might have planned. When actively managing your trades, ensure that a positive risk-to-reward ratio is maintained through profit-taking and stop moving. Never move your stops, or by that I mean increase your risk. Trade setups. Have a stop and target that are defined by price action regardless of the strategy used, and stick to your setup. If you follow these rules, you will find trading to be a lot easier than it would be if you are consistently moving your stops, cutting trades early, and ignoring risk-to-reward ratio. I hope this is helpful. If you have any questions, please don't hesitate to contact us. I'm sure I will talk to you soon.